On August 22nd, the VIX hit the lowest, I'm talking now about the spot VIX, hit the lowest levels of the year. Today, we're really pleased to be joined once again by Brett Friedman of Winhall Analytics, OptionMetrics Contributor. Today on Open Interest. Hello, everybody, and welcome. You cannot see me, I don't think, but maybe you can hear me. We'll get the video sorted out pretty shortly. In the meantime, this is just going to be a voice-only podcast. But the topic that we're talking about today is the VIX, and I'm really pleased to be joined once again by Brett Friedman. Brett Friedman is a longtime options trader. He's done a lot of quantitative work. He runs Winhall Analytics out of Utah, and he's also a frequent contributor for OptionMetrics, which is an important source of options market data and analytics. Brett, how are you? Yeah, it's been too long, I think. So, I think this is a question that a lot of people have. What is going on with the VIX? The way I think you described it when we were talking about this ahead of time was the VIX doldrums, or the VIX doldrums about to come to an end. And actually, one of the things I wanted to ask you about is, are we really in VIX doldrums? Because as I pointed out, spot VIX did in fact hit the lows for the year, and one of the lowest levels. I might actually be able to pull this up on my screen. I think I had a spot VIX chart that went back a couple years over here somewhere. Let's see if I can find it. There we are. So on my screen right now is actually the level of the spot VIX since before the pandemic. So this dates back to August of 2019. And we did have some periods where the VIX was lower than it is right now in 2023 and in early 2024. But in general, for most of the last 6 years, spot VIX has been much higher. What are your thoughts about, first of all, is spot VIX a valuable metric for investors and traders to think about? And what else should they be looking at? How should we really be thinking about volatility here?
I think one of the things you have to keep in mind is that people think that the VIX is in doldrums or is quote unquote, too low, which is what I've heard a lot. And I think that's more of a response to the sort of the socioeconomic sort of political situation more than anything else. They see radical changes coming out of Washington. The economic uncertainty indexes are making new highs all the time. So that, and for whatever reason, it's not reflected in the VIX, which a lot of people, deem the market's fear gauge. So the question is, why is the VIX not reacting to it, or are their expectations for the VIX unrealistic considering how it's calculated? I lean towards the latter. This is not a socioeconomic fear gauge. This is a fear gauge related to the SPX. It's as simple as that. It's 30-day implied volatility, essentially. So as a surrogate for volatility of the SPX, yes, it's an accurate gauge. In my experience with people who say that the VIX is broken or the VIX is no longer an accurate representation of volatility, usually correlates pretty high to that they lost money in the VIX, and they're claiming that it was somehow fraudulent. Uh,
It didn't do what
yeah,
they wanted, so there must be something wrong with it, or it didn't do what they had bet on.
right, right.
The roulette wheel has been fixed. Um, yeah, from like the movie Casablanca, when Rick decides to take care of that woman who was otherwise going to be depending on the charity of Captain Renault. So you actually shared a couple slides with us, which I think is probably valuable for us to take a look at. And I'm sure we'll probably get some questions about this, but why don't you just sort of walk us through what we have here and how we should be thinking about these things. And by the
Sure.
way, I encourage people to take a good close look at what's on your screen, because there's a little bit of nuance to this first chart, because it's not just a chart of the VIX. You've actually got some other things being revealed here too.
Yeah, forgive the labeling. Uh, Basically, these are VIX futures. 30-day futures versus 182 days. So basically 1 month versus 6 month futures. And we look at the shape of the curve. So the curve is either usually VIX is usually in contango. That is, the front months are lower than the back months. And every now and then it goes backwardated, but it's very rarely backwardated. It's about 81% of the time it's in contango, front under, which is pretty standard for VIX. Uh, you can see when it goes backwardated, it's due to something extraordinary, like the tariff panic of early April caused it to go backwardated, and I wrote about that. That backwardation occurs, but it's rare and it doesn't last long. Similarly, you can see since then, if you go to the next slide, that we've changed the curve shape has changed uh, since May, basically. So we were backwardated, and now we've gone to contango. And the contango is getting, if you go to the next slide, the contango is getting steeper. Uh,
Yeah, actually, if we could for just a moment, back up to that prior slide for just a moment, if we can. One of the things that immediately sticks out to me here is that the longer dated VIX futures are at present higher than the longer dated VIX futures were back at the time when spot VIX was considerably higher and we were actually in backwardation.
Yeah, I'm not, that could be some data. I noticed that too. That could be some data issues. You have to keep in mind that the VIX futures, the volume in the back dates gets fairly low. So I'm not, I wouldn't bang on those settlements, the backdate settlements too hard. So I, I'm suspicious of that, whether you could actually trade that or not. But it is an interesting observation regardless.
It was something that I noticed just before I we get back to what you're about to talk about here, that I was comparing recently the VIX curve to where it was a year ago. I actually have that up on my screen right now so people can take a look at it. And the comment that I was making, and this was we were not in a year ago, we were not in backwardation.
Yeah.
But we had some interesting events upcoming. So,
Yeah.
for example, and you can see that, if you take a look at the October VIX future, and the October VIX future would be looking out through the election. So we had the 2024 election was represented, which is the reason you see a big bump in the volatility surface at that point. But what is very interesting to me about these two curves is that the longer dated VIX futures now are substantially higher than they were in August of 2024 when, assuming we had a new administration coming in, which I think the polls were predicting at the time, or that a lot of the money polls anyway were suggesting that Donald Trump was going to retake the White House. What is interesting is that we have higher VIX futures of similar tenor now than we did then, and you would have been anticipating a lot of changes. We certainly got a lot, but maybe the market wasn't expecting quite as much once the new administration took place. You can see that sort of bump right here. I don't know if people can see where
Yeah.
my cursor is, but you could see that there was some elevation in the VIX futures curve after Inauguration Day. But this is where we find ourselves now. So this is January 2026 and beyond. Um, you know,
Well,
the
I mentioned before that there are a couple academics have for a long time have been putting out this thing called the Economic Uncertainty Index, which is basically a scraper. It scrapes articles about economic uncertainty and as to, and basically the amount and everything. A couple months ago, it reached an all-time high,
mm,
higher than it was during the 2008, higher than it was during the Great Depression.
that's amazing.
Yeah, I wish I didn't know we were going to be talking about this. I would have brought up the screen, but it's called the Economic Policy Uncertainty Index, and they update it all the time, and the methodology is pretty consistent, but it made all-time highs. I think since possibly early 1900s. which
So
is an
this one's a
amazing.
more volatile version. I don't know whether there's a smoothing mechanism that might play into effect, but let me see how far. I don't know if this is oh yeah, there we go.
Yeah. So
So
look
this
at the
goes,
right hand
this one
side.
doesn't go quite back to that period, but the data I have goes back to, when does this start? 85, 84. Looks like I have data back to, all right, so from January of 85 to present. And for anybody who's having a hard time seeing, I'm just going to draw a little line. There you go. Okay,
Yeah.
so um, not quite back to the Great Depression, the data that I happen to have, but that's 40 years, you know, 40 years worth of data right there.
Yeah,
Um,
and you could say that, there were, it was before the advent of social media, blah 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 blah. Blah. But but the fact remains is that the index is making new all-time highs, which is an
higher
amazing,
than the GFC. Wow.
thing. It really is.
Yeah.
So hence, yeah, and that's only happened since the inauguration, which seems like a million years ago, and and you can see why. So I could see why the back dates of VIX are kind of elevated. But what surprises people is, why is the front then not elevated?
Mm-hmm.
Why is the curve so damn steep? Uh,
To what do we attribute that? So this is we're going back to your slide now, which
well, if
sort
you
of
go to
shows that. Yep.
yeah, if you go to the next uh, not the next slide, but the slide after that, I can show you. So you can see
Mm.
that since the sort of the tariff panic went away and everybody started to live with it and realize that, there's a lot of noise, and what actually happens is walk back and all this other stuff that, you can see that the contango is getting steeper than it has been. The average contango in VIX since about '06 is about negative 280. And currently we're trading around $5, whatever, however you
Yep.
want to, whatever increment you want to stick on that. But
Right.
it's five. So it's almost, we're coming up to like 1.8, something like that. So it's a pretty serious number. And if you go to the last slide I have, I can show you something that's really interesting.
Mm.
The very last. Yeah. So, and I have to tell you that the Excel AI programs make stuff like this a lot easier to do. So I went back and said, okay, so what was for various VIX ranges for the front VIX, for the 30-day VIX, when it's trading between a different brackets, where was the contango on average since '06, or since February 24th, 2006. So you can see between the 14 and 16 area, which is currently where we are, it generally trades about negative 277. That's the average. And
Mm-hmm.
currently, again, we're trading at like 495. So, I mean, 495 is, that's for extremely low numbers that we don't see all that often. So,
That would be probably. I'm trying to think when. And we had some artificial things going on then. So late 2017, short dated index options were, implied volatility was very low. Realized was very low at that time, but we had extraordinarily low implied volatility. You may remember, trying to remember what the ticker was. There was an exchange traded product that was systematically short VIX, and it ended up blowing up. I think it was either late January or early February of 2018.
that was
Um,
you referring to Volmageddon or whatever they
yeah,
called it?
Volmageddon.
Yeah.
Yeah. So the reason, I mean, it sticks out to me for a couple of reasons. First of all, at the SIBO Risk Management Conference. So SIBO, for those who are unfamiliar, that's formerly the Chicago Board Options Exchange. Um, they hold something called the RMC, the Risk Management Conference. I'm not exactly sure what the schedule is because it's been a couple of years since I went, but they used to have them in Europe and also in the US. But I remember distinctly the one in 2017. I think it was maybe around April of 2017. And the reason I remember it so distinctly was because Christopher Cole, who was a hedge fund manager and tail risk fund manager for a firm called Artemis, he was one of the speakers at that conference, and he was talking about his concerns about the risks that were being taken in the short vol space. And he specifically spoke about that exchange traded product. And it just so happened that the guy whose product that was, and that bank that issued it, was in the audience. And I can remember this so distinctly because he stood up and they were basically, they were getting into it about that product and about what was going on and about how it would turn out. I don't think Christopher Cole was rooting for anybody's failure, but he discussed how dangerous he thought this situation was. And at the following year's risk management conference, that it had already happened. So the prediction he had made had already come to pass. They had sold vol down to an exceptionally low level, and it is a mean reverting process to a degree, and it had reverted very violently, and the unwinding contributed to the ensuing volatility as well. So basically, it was one of these things: when you sell a lot of volatility to the market, is it possible to compress it? And if that comes undone, is it possible to, cause a worse conflagration? Do you think there's any of that dynamic going on right now?
Yeah, to a minor extent. I mean, the minimum number, the highest contango ever was, I think, 881, somewhere around there. The highest backwardation ever was 35 and a half.
Mm,
It's an asymmetrical distribution that when VIX goes up, it races up, but not for long. But when it goes down, it tends to hang out there for a while. So to me, it indicates that people get very complacent and then they get caught. And then it's the rush to everyone's trying to get through the same door. So,
hmm
but currently though, we're at 5, and it doesn't really feel like to me, although, as you said, it's mean reverting, and eventually, I know this contango is going to go away eventually. There is something going on with the summer. I mean, VIX during July is generally, it's seasonal. VIX during July is the lowest level usually, for the last, like, that's just the low month for VIX generally. October is the high month for VIX. So
hmm
maybe as the summer goes away, people start trading again, you'll start seeing volatility coming up and this contango will get reduced somewhat.
Yeah.
Uh,
So I don't know if you can see my screen or if we have it up here. I'm just going to show this really quickly. This I happen to, for purposes of my own, just recently, because we hear all the time about these seasonal volatility
yeah.
effects. So this is not implied volatility. This is realized volatility. 30 calendar day trailing going back a century for the S&P 500, or the closest proxy that we have for it. And actually, I can probably make this just a hair bigger, so I'm really filling up the screen and people can kind of see what's going on. And what you're going to notice is that September is historically, above average, which I'm pointing to with my cursor right now. October is is the highest by a good margin. November is second. This surprised me because if you had asked me 2 weeks ago what I thought the number one and number two most volatile realized volatility months were, going back a century for large cap stocks, I would have said October number one and September number two. But it turns out November um,
Well,
is number two. But the reason I suspect this is the case is, one of the things to remember is that a large number will throw an average a lot more than one that deviates considerably from the mean. And what do we have? In 2008, for example, the GFC, it was October that things started to turn particularly ugly. Not that they weren't ugly before then. I mean, some would and could and probably should argue that the GFC began in September of 2007, but those cracks were largely unnoticed by a lot of investors because they were mostly turning up in the fixed income markets more than they were in equities. And it wasn't until, it basically the Chiaffi fund at Bear Stearns needed to be rescued that I think everyday equity investors really began to recognize, hey, wait a minute, there's something very wrong here. But that came as a bit of a surprise to me, I have to say. So do you think that just the seasonal effects post Labor Day, or do you kind of dismiss this because while it's true that these numbers are thrown a little bit to the high side, that it's really a handful of really volatile events that toss them more than just sort of a more systematic seasonal effect? What are your thoughts on that?
Well, I actually have a slide on this.
Oh, let's have
Thank
a
you for
look at it.
reading. It's average.
See, that's why we have you on here, is for this kind of expertise. You come prepared. I just so happen to have.
The one before that, the one, or yeah, this one. So I took the average month. I just average VIX, the 30-day VIX, the 30-day continuous futures by month. And you can see that, July is obviously the lowest and Q3 is the highest. But, I see differences between October and November, but October is inflated for just the reason you said. There's a bunch of outliers in there that make the numbers go crazy. The October surprise, I wrote about this in another column that I wrote, is it really true? And it's true to the extent that some things have happened in October, but a lot of stuff has happened in September as well, and a lot of stuff has happened in every single month. So it's more apocryphal than anything else, I think,
Mm.
quite honestly, that people think something's going to happen, so they don't start, so they're a little hesitant to be selling volatility. Uh, but you can see November's pretty high as well. But they're kind of in this whole Q3 thing. They're kind of in a tight band. So it's not something that I'm I would say, oh, there's a trade here, or there's a trade not here. You know.
Well, that actually was going to be my very next question. So, um, I used to trade options on natural gas futures, and
My
for those
condolences.
who are for those who are unfamiliar with the dynamics that go in that marketplace, natural gas is a slightly different beast than oil, in the same way that electricity is a slightly different beast than natural gas. Anything where supply and demand imbalances, that basically the window of time that you're observing is shortened, are going to exhibit considerably higher volatility. And the situation with natural gas is that natural gas is conventionally stored in things like depleted salt mines. So uh, you're producing natural gas when there's an excess of it. You inject it for storage. Um, and that goes on until demand outstrips the immediate production of natural gas, and so you have an injection season and you have a withdrawal season. And volatility, not surprisingly, has often been higher in those periods. At the tail end of the injection season, if all of the natural gas storage is basically filled, then the price of natural gas can plummet because there's no place to do it. In fact, in the worst circumstances, they actually flare the gas because the gas is coming out. There's no place to put it. And by contrast, during the withdrawal season, you have this elevated volatility because if demand outstrips supply and you've essentially exhausted everything you have in storage, then natural gas prices can really go substantially higher. And the reason this is important in this context is that a conventional trade that a lot of folks would use in the futures was to put on calendar flies, right? So they would try to say, okay, well, this had to do with the curve in natural gas futures. And they would say, well, if I think one portion of the curve is too high or too low, then they would buy a future before and after, and then potentially sell the ones that they thought were overpriced, or do the opposite, which is, if they thought it should be the other way. So you don't, in this unusual VIX futures curve shape, and this is not something I think that I've heard anybody really discussing much, and certainly not in conventional news, business news, probably because it's a little wonky. But what are your thoughts about that? You were just commenting that doing that kind of thing can be painful if you
Yeah.
try to do it.
Uh, go to the slide before that one. Okay. So, and and let me tell you that having traded natural gas options as well as power options, this is the trading VIX spreads is a rowboat compared to those two, which are the Titanic. You truly want triple digit volatility that can rip your face off. You know, there's no question about it. That is the king of volatility, of crazy volatility swings. I've never seen anything in power. I've never seen anything like that before in my life, and hopefully never will again. Uh, but in this average VIX by the you can see the average VIX spread by the month. So this is the 1 to 6 month future spread by month. And you could see that there is some seasonality here. Uh,
Hmm.
I think the seasonality may start affecting it because this is essentially the front month versus the 6 months. So the front month affects the spread, obviously. So you'll see it starting to come down. And I think that's probably what's going to happen in the absence of anything, external going on, you know, like, the rate cut doesn't materialize or there's peace in the Ukraine or a million sort of gray swans that may come along, not black swans, gray swans.
Hmm.
So this is going to have an effect, I think, on the contango, and it's going to come in, I suspect. Again, unless something happens that's just crazy. Uh, but when people tell me that the VIX is mean reverting, and that's one of the reasons that they're going to go, they use this as a contrary indicator sometimes that the contango is high, so therefore it has to come in. Uh, yeah, it is going to come in, but the question is when. Uh,
Mm.
are we going to hold this trade? I mean, that's a classic trade for people who don't trade. Are you going to handle the mark to market every single day, in negative until this damn thing comes in? There aren't many places that allow you to ride the spread from 5 all the way up to 8, saying, well, I think it's going to come down to 2. Most places will say, well, you got this the wrong way around and we're not waiting around. We have better uses of our capital, frankly. So mean reverting trades is one of those trades that like professors do, and then they get destroyed. And hopefully they never trade again.
um, Long-term capital management days, they had a number of PhDs that
Yeah,
were in a big mean reversion trade at the
I knew
time. I
two of
encourage.
them.
What's that? You knew two of them.
I knew two of them. I wouldn't trust them to make change of a dollar using without an Excel spreadsheet. I mean, it's incredible. It's incredible. It's like you're going to get so destroyed. But you know, all trades make money. The question is when. It's if your timeline is infinite, of course you're going to make money. Uh, but getting back to the VIX, at this tour with this personally, when I look at it and I see this level of contango and I see the level of the VIX itself, am I comfortable being short the VIX? Not really. I mean, one of the indicators is flashing that, I don't know about this. There's something going on here that it's a yellow light at best. It's not a red light, it's a yellow light if you want to be short the VIX.
Do you suspect, we've seen a big proliferation of, additional products that trade options as a key part of their strategy. I'm working with a team, for example, that does a lot of, the most basic option strategy, I think, that has been out there for the investor class. And then what I'm saying, I don't mean that in any kind of a pejorative sense. I'm just talking about people who have sought to maybe get a little bit more yield or distributions out of a portfolio who are otherwise just long stocks. Um, Now, in the case of the yield max ETFs, and the yield max ETFs are not small, they're not the biggest participants in the options world, but we're not small. We're talking about just shy of $20 billion. Not a lot in the index side, mostly in single stock space. But are there products out there that you wonder or have identified that you think those could be playing on this, because one of the things that you have looked at, I'm sure, over the years as an options trader, and I certainly have as well, is the relationship between single stock volatility and index volatility, sometimes described as implied correlation. So when index vol gets very low relative to single stock vol, we would say that implied correlation is really low. Because if you had perfect correlation, then the sum product of the weighted volatilities of the constituent stocks would equal the index. Actually, I've seen situations where, believe it or not, it actually went over that theoretical level. In October of 2008, implied correlation in the S&P, very briefly on my screens at least, went to 130%. So there was so much dislocation in the markets that the options market was saying that all of these assets will be more than perfectly correlated, which is obviously impossible. Similarly impossible was any real mechanical way to take advantage of that trade. I was trying to figure out, like, how do we do something about this, but the liquidity was so poor, and the prices were moving around so violently that there was no way to really put that trade on. But do you think there's something going on here where there is a trade that's being put on either in a listed product that we can see in good size, or maybe someplace else? And maybe there's a product that's being sold by banks that's having an impact in depressing this, or do you just think this is a natural dynamic that just has seemingly stretched to an extreme?
I think there's a long-term trend for the so-called income producing products, which became popular a couple of years ago. Basically the covered call strategies where you're getting retail investors extra income on their portfolios. I mean, those are increasing in volume, and you know they're not bullish for volatility. I'll tell you that. I mean, it's depressing volatility. The degree to which I'm not totally sure, but they are depressing volatility, and the amount that retail participants are trading options is just vertically. How many, the retail participation in the options markets is probably the biggest change I've seen over the last 5 years in the options market. The dynamic has changed, and the switch to, and this is another thing, the switch to zero DTE options,
Hmm.
or close to zero DTE options, has also changed matters, where you're not getting a ton of volume in the back dates of volume of options anymore. The action is in the front of all the options markets. That's where the majority of the volume is. So the options markets are rapidly turning into sort of a prediction market rather than the market that I grew up with and I'm used to, which is fine. Markets change, but I think both of those things are the fact that volume is shifting away from the monthly options towards the front of the curve, the extreme front of the curve, as well as the introduction of these income producing products, are both, I think, acting to depress volatility somewhat, uh, which means to me that when it does, and I think one of the byproducts of that is that when people get short, the explosion is a lot more violent than it used to
Hmm.
be, I think, and almost to the point of uncontrollable. I mean, we saw that during April 7th, where the first couple of days of the
The
tariff
Liberation Day stuff.
Liberation Day, where I think the effect of Liberation Day during World War II was less than the Liberation Day of the town. I mean, you would to read the news reports, it was just like the world is coming to an end. And that's the way the market reacted. And I think a lot of that was, at least in the VIX, was people were caught. They were caught the wrong way around. And so,
You brought up a really good point, the zero DTEs, and arguably one of the things is we don't have zero DTEs on single stocks. The zero DTEs and the every others were on ETFs and indices, which, of course, if you're talking about the SPX options are what the VIX is looking at. So that's how the VIX is calculated. It's off of the interpolated strip, weighted strip of options prices expiring in 30 days off of the SPX index. Does this, I guess, we could look at this and say, Is that part of what is causing this? And I guess the next thing is there is an element of self-fulfilling prophecy in this, because if retail's not a fair characterization. Let me put it differently. If the bulk of self-directed options traders are selling premium 30 days and less, then the dealer community, market makers, my former job, would necessarily then be long a lot of gamma. And if you're long a lot of gamma, then you're selling a lot of deltas when the market rises, and you're buying a lot when it falls. Maybe you're not trying to beat yourself up, so maybe you have discrete hedging intervals, but that very action compresses realized vol. So there's a reflexive element. Do you think that could be playing into this at all?
To a certain extent, but let me begin by saying by making a comment on the first thing that you said, was that there's no zero DTs on individual stocks
Other
yet.
than expiration day.
Right. Yet. And I think that's coming. I mean, there's been news reports, rumors that they want to introduce this year. And we have the perfect administration to allow that to happen. That will be a seismic change in the options world when you start getting
Hmm.
individual stock options. It's like, I'm not even totally sure they should exist, but cool. They're coming, whether you like it or not. That's the way the world is going. Uh, who's long, who's short, these things. I mean, my gut reaction, and I use the term retail for non-institutional. It's not pejorative or anything like
Right.
that.
Hmm.
But, basically my reaction is that my gut feeling is that retail is, they're betting that this is a massive betting market. They're betting on earnings. They're betting on this. They're betting on that. These are essentially short-term Nvidia bets. They're long, and I think the dealers are trying to lay it off as best they can. So I think it might actually be the other way around. But
In
I'm,
support of that, well, first of all, we have NVIDIA earnings post close today, and
right.
I have right now the term structure for SPX, which anybody who's paying attention, if you can't see it, it's so steep that it looks like it's actually part of the axis, the y-axis. It's not, where my cursor is right now. That is the shortest options. That's the implied volatility of the zeros.
Yeah.
So what you can see is that you have this steep contango here everywhere but at the very shortest period of time, which, in support of what Brett was just saying, suggests that folks are using these zero DTEs as a mechanism, maybe as an alternative for some form of like a Delta One day trade.
Yeah.
Um, and
I think that's exactly what they're doing. But to
yeah,
characterize these as volatility trades, there's no volatility. I mean, the it's sort of a non sequitur with the day to go. I mean, what does volatility have to do with this trade? Basically, you're betting on, is this going to be over the strike or under the strike? It's a digital
exactly.
trade, and it's as
Hmm.
simple as that. And most of these things are fairly cheap, and they figure, for a couple bucks, I'll punt. It's sort of a dark horse at the track.
Yeah. I
So,
mean, as far as the zero DTEs on single stocks, I mean, I wonder. It used to be a big technical challenge for those of us in the options market. It was a computational issue, it was a bandwidth issue to push so many quotes. At this point, my biggest reason for supporting the idea would be that I prefer circumstances where, if you're going to trade the product in one underlying, that you make it possible to do it in most of the underlyings associated with that. So if you can do it in the S&P 500 or a proxy for it, I rather like the idea that you would be able to do it for all of the constituent stocks, because there's going to be a relationship between these things, and you know the more pure, I guess, people can make their individual bets, I would say the better. The flip side of that is that it does introduce, do we want it to be a market for investors, or do we want it to be a market principally for speculators? Um,
I
and
think I think the gamification of the markets, I think that horse is long fled the barn, or whatever that expression is, you know. But I think,
the horse is out of the barn. I think that's sort of how it. Certainly, it sounds right to me.
yeah, but this has been going on for a while, and and one of the more interesting developments that I wrote about a while ago, but I'm going to look back into it, are the prediction markets, which like Polymarket and Kalshi, et cetera, et cetera, and some of them are, they're moving into the financial sphere, where you
Hmm.
can bets, over under bets essentially on the S&P, et cetera, and those are, if you think about it, they're essentially options. They really are. Only on it, they're not conventionally quoted, but they're options. Uh, and that, those things are gaining, they're gaining a lot of traction. You can do them on anything. Uh, they're offshore, they're not really regulated. And so to me, that is that's where the options market, if they, the zero DTEs, the gamification, the prediction markets, this is the new wave of stuff. The market that you and I grew up with, I think, where we're playing volatilities between 3 and 6 month, and hedging our deltas and hedging our gammas, I think is sort of gone with the wind, honestly, at this.
Yeah, well, it is interesting. I mean, I had fairly substantial positions even in leaps in the late 1990s. That was not that uncommon. I mean, I also traded things like tobacco names. I had positions in Philip Morris, so there was there was kind of an idiosyncratic thing going on in that space. But to your point, well, first of all, we didn't have zero DTE options. Weeklies were not even a thing yet. So there was the front month, and then further out, and the more actively traded names. People focused actually more about the release of the leaps than they did a shorter dated option. In other words, you could sort of tell whether a name was well trafficked in on the options side by whether or not they listed leaps in it. So
But
it's
you also had some clients asking for, very customized products in the over-the-counter market,
hmm
that just aren't exchange traded. What do you make me for an option that expires at the end of the week? A crude $40 call. What do you got? Uh, it's kind of like, I don't really know.
well, yeah, we had on the crude side we had positions that went out 5 years. I'm going to let you go very shortly, but before I do, I'm going to put you a little bit on the spot here. Not asking for a trade idea necessarily, but you've been observing these markets for a long time, and as you pointed out, what we're seeing is in a couple different places is rather extraordinary. So I'll ask you this question, and that is that, in your portfolio, are you longer than usual, not as long as usual? I'm assuming you're not the kind of anybody who's been in the business for a long time. Most of us are not net short markets. That's just not the way we typically go. But we can be tactically short from time to time. So I'm curious, how are you leaning as Labor Day approaches relative to your own investing history, having had a good bit of experience in the markets by now?
I can say that longer than normal. And the reason I am is from my experience as a risk manager. Generally, as a risk manager, one of the things you have to do is shut down bad trades and listen to the trader gripe about why they were shut down. But generally, when the trader gets shut down, they give you a million reasons why this trade was wonderful, despite the
Mm-hmm.
fact that they continue to lose money. And my response to that always is there's something about this market that you don't understand. That's why it's going against you. You're missing something. And every single day, I read bearish news about the economy. I read bearish news about the administration. I read bearish news about the market. And yet it still goes up. So there's something cooking here that's
Mm-hmm.
different. And I think a lot of the analysts are sort of confusing their beliefs about the administration, whether they like it or don't like it, whether there's too much change, not enough change, who knows? And that's leaching into their view of the market. And they're two separate, they really should be two separate things. They, you know, they react to one another, but they really should be two separate things. So that's one of the reasons I am longer than normal, because I just think there's something going on here that I can't put my finger on, and yet the market keeps on going up.
You know,
So
they often say that bull markets climb a wall of worry.
worry.
And to a certain extent, I guess one thing I would say, well, I'll offer two things on this. One, I have been asked, um, when is the time to sell? And one of the things that I say is, the market's going to tell you. And the bad news about that is that you are probably going to miss the turn. You're going to lose a couple percent. But here's the flip side to that I would offer, which is that if you were not long because of all of the good reasons that people could offer why you shouldn't be, you will leave a lot more money on the table than you will by basically sticking with the winning trades until they start to lose. And you will lose a little bit, because by the time you see that they're rolling over, maybe you've given back 5, maybe you've given back 10%. But the market's been up well more than 10% a year for several years now. And it would have been a shame to have left that. And
Yeah,
stocks generally go up.
and embarrassing. The but to the people that ask me that all the time, it's not the first time I've been asked this. My question is simple. Tell me a period, go back in time and tell me a period that you would have been long without any reservation whatsoever. Tell me a period. Every single period has problems. That
Hmm.
there's something on the horizon. And that's why we make money. That's why there's risk. But you're never going to find a period that's like, oh, I'm going to be long and I have no reservations about it whatsoever. No,
Yeah.
that's
It's a
never
sure
the
thing.
case.
It's a sure
It's
thing.
it's
Actually,
never
we
the
got a
case.
we got a question here, and I'll ask it to you first from a viewer named Steve Garcia. He says, "Why do fund managers underperform the S&P 500 so often?" And he cited a statistic here, which could probably be validated with the SPIVA reports, but I don't have them in front of me right now. 80 to 90% over 10 years. And do you really believe that's true? Well, I think that's documented. If it is, why do people continue to use fund managers? Is curious to me. Thanks. So Steve's question, I'll send that to you first, Brett, before I give my own 2 cents on it.
I'm assuming by fund managers he means active fund managers. They're not just long only.
Hmm.
Well, there's two things. There's fees, which are biting into their return, which get compounded over time. And B, when you sign up for a hedge fund or a fund, you're not really asking them to invest in the indexes to go
Hmm.
buy SPX. That's not why I'm paying fees. I want you to, use your best judgment and buy some or sell some other stuff. Most hedge funds that I've come across have, they're hot for like a couple months because they come out with a specific strategy that happens to be working, and then they get cold.
Hmm.
But they already got all the money, so that's cool. Uh, so you have to realize that the main object of a hedge fund is to gather money. It's not to perform. Once you gather the money, the hedge fund managers are making a lot of money on the maintenance fees and on their percentage fees, et cetera, et cetera, et cetera. Uh, you know, they don't really have to perform to make a lot of money, uh, personally. Uh,
So, yeah, I mean, I guess first of all, having worked at a hedge fund, I can address. There's a couple things that are going on here. One thing is that something like the S&P 500, uh, it will benefit because you can get some outsized positions in the biggest winners that active managers can't take, just simply due to concentration rules. So, for example,
right.
at the hedge fund I was working at, I'll just give you the general sense of what that portfolio looked like. Any position, any single name position we had to be at least 50 basis points of the fund's value. Any position could not be larger than 5% of the portfolio's value. So for $1 billion, that meant no more than $50 million allocated to a single name, long or short. We were about 40% net long on balance. What did that mean? That meant that if we had $1 billion, we are carrying about $400 million deltas. So if you netted out our longs and our shorts, we were carrying a long balance. But if the market's going up 20% a year, there's no way that strategy is going to keep up. You would have to have knocked it out of the park with several of your single stock holdings just to keep pace. Because remember, they're going to be 5%, but the whole fund is only net long 40%. So that beta component has been sucked out of it. The other thing is that the indices have no presumed cash balance, right? They're fully invested all the time, always, every single day. And that's not true. And then as you point out, of course, there's going to be fees, but I think I was not on the marketing side, never sat on like a pitch meeting. So I don't know what the institutional investors were asking. That hedge fund got up to about $5 billion at its peak. But I do know that low volatility was really, really important. That the investors, the institutional investors, typically pensions, endowments, and trusts, they relied on those assets and were liquidating a portion of them really frequently to meet distribution requirements for their respective trusts. And because of that, they could not accommodate significant asset volatility within their broader portfolio of assets. So they really liked things that either were low vol, and what they liked even better, although we didn't exhibit this because we were in the stock picking business, were non-correlated or anti-correlated assets. So if you have a hedge, think about that. If you have an anti-correlated or non-correlated asset, that's not going to track like the S&P 500, but it's of huge value to the institutional investors. And you're on the risk management side, so you know that better than I do.
And I've sat through triple-digit number of investor meetings with the investors from the various funds I worked at. And I can tell you what you said is exactly true. They want low vol and they want non-correlated assets. But they also want returns.
Yeah.
And I've sat there with people that are really smart, and it's like, no, I can't give you excess return if you want really low volatility. That's just not going to happen. It's
Well, what they really want, they want double-digit returns with single-digit vol.
Right.
Which is a Sortino. They want a Sortino of 2+.
Right.
That's like if you could draw it up on a card, like if they could just throw a number, they'd say Sortino 2, which means essentially that your returns are doubling your volatility. And I'm talking about only your up moves, right? So Sortino, unlike a Sharpe ratio, focuses principally on its upside volatility is fine, downside volatility unacceptable.
But the non-correlated assets too, which means that you have to start trading some stuff that's a little out of the mainstream. And usually they don't like you doing that. So, the constraints that they put you on are kind of unrealistic, frankly. They're realistic for them, but eventually you get down to the point is, buy some bonds and clip coupons. That's really going here.
Well, I've got somebody here who seems to be very willing to take some risks, and so he's got a question for you regarding leveraged ETFs.
Oh, yes.
When I look at SPY 3X versus SPY over 10 years, I see clear outperformance by the 3X. So why people say they aren't for the long term? Thanks. What's your answer for DJ here?
I'm not sure I'm really getting this.
So basically, you know what? I'm going to pull this up. So let's get a 3X. First of all, the 3X levered ETFs, they've kind of cracked down on that a little bit. So I don't occupy that space, but let's take a look at what is the most
clear outperformance of the 3X over what?
Well, he's saying a 10-year performance. So that makes sense. Look, I mean, the S&P is up considerably. And let me find a 3X long one. Maybe someone can... You know what? Let me just I'm going to just put in a 2X because actually that's going to work just as well. Yeah. So we're going to do this. So I don't know how long this one's been around. Let me see. So this is 5 years that I've got here.
So
Um,
you're just gonna
so
buy the
this is SPX index. So this would just be the S&P 500 or its closest proxy that we have, which is the SPX. This is a 5 year time history. And we have SPOO, which is the direction daily S&P 500 bull 2x. So this is a 2x levered ETF. And it is true that the total returns for SPOO have been considerably higher, which makes sense because what has happened over the course of the last 5 years, the market has gone up 100% in total return terms. Now you're going to see that this is supposedly 2x. You didn't get 2x. You didn't even quite get 1.8x net of fees and distributions in the levered ETF. So the thing that I would actually encourage people to take a look at is that if you go back to where my cursor is now, over here by the left hand side, and you see that the S&P round tripped in this period here, you did also round trip in the levered ETF, but actually I think this levered ETF, let's see here, can't quite see. There was a period in here where it actually underperformed on a relative basis. So you could have a situation where the S&P is essentially flat, but net of everything that you put into it, the levered ETF would not be. Look, if you have the stomach to handle the volatility, and you're the kind of person that buys something and you're going to be retiring in 30 or 40 years and you're never going to look back, the levered ETF is not necessarily giving you better risk adjusted rates of return. If you adjust for risk, they are probably worse because it's giving you double the volatility, but it's not giving you double the returns, or it's giving you triple the volatility day to day, but it's not giving you triple the returns. I don't actually know whether I would go with one of the triple X ones because I have seen, as Brett has, I've seen the NASDAQ fall 80%. So would some of these things blow up completely? I'm not 100% sure. I don't think they would, but
I
um,
I lived through various crashes, and the financial crisis being the last one that I lived through that went on for a while.
mhm.
I think people who have not lived through that, they've never really, quite honestly, lived through an extended bear market, where it's just every single day it's coming off and it just feels relentless.
I
Get out
I
of the,
do remember that from March
but
of
take
2000 to 2002
Yeah, I
in
mean,
the
take
Qs.
one of the leveraged ETFs. I mean, that's the name of the game is risk adjusted rate of return. It's not return,
Hmm.
in my opinion. If you want return, cool. But you're going to have to live through. If you look on the right side of that chart, I'm not sure because I can't really see what the date it was when it just came off hard.
Oh, right over here.
Yeah, what is that?
That is that was the beginning of this year. So that's the peak here is February 19th of this year, February 2025. Um, yeah, that's that. I mean, if you were in these things, and perhaps some of the people viewing this actually were, that was pretty punishing. Um,
It's easy to say in retrospect, I would have held.
yeah, yeah.
Generally you would have held with someone else's money. But when it's affecting your lifestyle and you have to look at your you have to look at your wife when you get home from work and say, well, we just lost 25% of our net worth, on
Hmm.
leveraged ETF. See what she's going to say.
Yeah, probably won't be
Happy.
super enthusiastic. So yeah, what we have now is SPXL. So we've got the 2X and the 3X in here. The 3X, wow, that was quite. I'll give it to somebody who can stomach that kind of
Yeah.
a drawdown. So that was 227 at the peak, and yeah, it's less than 70. It looks like
Juice.
on the low.
I mean, that's serious.
So
That's a serious number.
yeah.
So, there is a school of thought that says that the leverage ETF phenomenon is a sign of an overcooked market, a long-term overcooked market that you start getting these very leveraged products and very esoteric
Mm.
products coming into the market. It's a sign of, there's too much going on. To me, it's not really I'm not totally sure. To me, it's very similar to the zero DTE phenomenon. You have a new class of traders entering the market that want higher risk products and seemingly can stand it.
Well, a lot of these
And
people, if they're younger, if they're in their 20s, you actually are, if you're 25 years old and you're planning to retire when you're 65 years old, I encourage a much more aggressive investment approach. Um, and if you can stand it, good for you. A lot of people can't. That's it's human nature. People don't like to see themselves bleeding off. You know, one of the things you mentioned when you started in the business, the way we used to measure how much comfort there was with risk before there were levered ETFs is we would look at the New York Stock Exchange margin balances, right? So,
yeah,
and then we would chart that, and as the margin balances got to record highs, you would say, and cash balances got low. That was a meter of sorts of the degree of exuberance that equity investors were exhibiting at that particular moment. High margin balances, low cash balances, risk on. And there
I
is a
think
limit, right? So if there's not a lot of excess cash balances, and my understanding is there still is available cash balances, I don't think that's evenly distributed. I think there's a group of investors that are arguably holding on to a bit of it, but that's another way to think about this,
I
as
think
well
that's
as
a
the
remnant.
proliferation of these products.
I, I think that's a remnant from like 1929,
Yeah.
with high margin balances and things like that. But people look at a million different, I think I'm going to write about this in the next couple of weeks about the various indicators that they use as to whether the market is overcooked or undercooked. And there's a lot of new stuff. And everybody has their personal favorite. My personal favorite, which you're going to laugh at, but it works like a charm, is generally when I get a call from a distant cousin or something that's interested in buying like a weird, like levered ETF or something that should never be trading in their world. When my distant relatives start calling me up about stuff like that, I know it's time to get out.
That's the old, like the shoe shine
You shine,
boy
right?
indicator, or you go to the barber shop and they're all trading stock tips and stuff like that.
Yeah, yeah.
I'm
Supposedly
bald
the
on
shoe
top, but
shine,
the sides could probably use a trim. I should get over there and see what they're talking about.
supposedly the shoe shine thing with Joseph Kennedy was apocryphal, was just not true. But that it stuck for whatever reason. So
It's a good story, but I think it is one of these things that it still has a valuable ring of truth in it, even if the story itself was apocryphal, which is that we have all experienced this. Everybody we have, and everybody watching has at some point begun to hear the newest, latest, greatest thing suddenly cross everybody's, dinner table. You can remember the earliest conversations. It doesn't matter. Bitcoin.com, you name it, AI stocks, right? Every one of these things were, you know, unusual at one point, and then they were totally commonplace at another. And then I think that tells us a little something. Well, we
it
have
depends.
already. Go ahead.
It depends upon your trading history. I traded silver very early in my career and got completely destroyed and never traded it again. It's like I burned that bridge so bad. I'm never trading silver ever, ever again. And it burned me so bad. So
um, yeah, I mean, I wonder sometimes whether there's what we need to do is actually ignore what the underlying product is, but I know exactly what you mean. There are circumstances where I have said this, people who have watched these videos know that for me, that's FedEx. I don't know what it is about Federal Express, but this thing has burned me several times in the most, and never in the same way twice. It's always something. We had an algorithmic trading error, and it was a more than 50,000 lot order just got sent straight down at the market. And I was literally watching my screens, and I saw FedEx move by a couple of bucks and back down, and I said, please let that not be me. So I had 140 some odd stocks in my portfolio at the time, and sure enough, I called, pleaded, just specialist printed it just inside the obvious error rule. How convenient. And we had a position in it. It was, part of a broader portfolio. It wasn't a real big high conviction thesis or anything, but we owned it when they had that disappointing quarter. Was it at the end of 2022? It was the worst quarterly earnings report that FedEx had given in basically since they were a publicly traded company. It was the kind of thing where I wanted to get on the phone and call Fred Smith personally and say, what the hell is going on here? And what's worse is the only reason we had an outsized position was because the stock had been doing so well leading into the earnings print. So we actually had more than our normal allocation in it. So it just made it seem that much more painful. Let me see if we have a couple more questions we could take before too long. So DJ says SPXL, which is the levered, is up. Triple levered S&P is up 900% for the last 10 years versus SPX 225. That sounds. I'm not going to doubt you. If you're saying it, you must have those statistics somewhere. So let's take a look.
900 is an even number, so I wonder about that. And so
I've got it's actually closer to 1,000. 998 spot 81. I have. That's quite extraordinary. I didn't even realize this thing was around that long.
Me either, honestly.
So that is okay.
I hope you're wrong.
Maybe it's as simple as that. Wind back the clock, become 20 years old again,
and this is
and just get long the triple levered S&P ETF. I'm going to go as far back as Max here. That chart, by the way, has this thing really been around that long?
I don't think it.
This is wow. This dates back to the GFC. Okay. This is it's a fair question. I'll be honest. I didn't even realize that it had been around that long. And admittedly, as an options trader, it's not our habit to get, unless you happen to be making markets in it, to get into. Yeah. Yeah. I mean, if you have a long-term holding plan and you can stomach the kinds of drawdowns that you saw here, like for example, here we saw a drawdown from 76 to 16. That's a pretty big pullback. This is a logarithmic chart, by the way, for anybody who's looking at this. If that's not a bad looking chart, but you really need to be able to shut your eyes.
I mean, everything's great in retrospect. I mean,
yes.
Remember Amazon I remember in the early part of the century, everyone was saying, Amazon's eventually the business model isn't working, it's going out of business, et cetera, et cetera, et cetera.
Yeah, Amazon. Well, I would say, with the benefit of hindsight, Nvidia is the place to put your money. Nearly 80% compounded annual returns, which is a lot better than this. I mean, I'm being a little bit cheeky here.
People are always asking me about this, that I wish I had bought Google, I wish I had done this, I wish I had done that. The question isn't what you wish. The question is, right now, there's a couple different stocks that are Nvidia, Google, Amazon. You just don't know who they are. Right now, they're available. Figure out who they are. That's the trick.
That is the trick, and if you can't do that, and you have a long time horizon, know that the S&P will eventually pick them up. The Russell 1000 will eventually pick them up. So if you have a 40-year time horizon and you want to have exposure to those stocks, you will have exposure to them if you own those indices. And like I say, I encourage aggressive long behavior on a dollar. Just every paycheck, put a little bit into equities. Because the opposite side of that is you're going to be long cash, and that's not a good place to be.
No.
We have a history of monetary debasement, not just in the United States, but it's the nature of things in human history. Money, whatever form it has taken, has been debased by governments pretty consistently. Even precious metal coins have been debased. They've sat there and they've mixed less precious metals into them. So, if you understand that reality, you understand there's a time value to money, you understand that economies generally grow, you understand that the best performing companies within an economy will typically grow faster than the economy itself, then you want to be long equities. And if you can stomach the volatility of one of these levered ETFs, I'm not in the business of promoting something like a levered ETF, so I'm not making that as a recommendation. But if you can stomach it, more power to you. You're a hardier man than I, or woman. And with that, we have now kept everybody for a little over an hour. Brett, this has been great. And the topic of your article sounds very interesting to me. The indicators, one that you're planning to work on. And so what I'd love to do is get you back here to talk about your findings after you complete that, if you're available.
I have to tell you that I don't know if anyone in your audience has ever written financially for a living, but I have to tell you that the hardest thing to do in these articles is figuring out what to write about. Once you figure out what to write about, it goes pretty quick, because quite honestly, I mean, I write weekly. Not that much happens every single week. There's some weeks nothing happened. I'm not sure what I'm going to write about. But
I write 2 articles a week myself. But the thing is, like the topic that you've just chosen, that's the kind of thing that I could become interested in. It's a little bit of a research project, and it's something that satisfies your own curiosity and hopefully some of the readers too. But I can tell you that the topic that you've just identified is something that I'm very curious to hear about your findings. So I hope you'll come back and join us once you've done that. Get the article out there. Your paid subscribers can give it a read, and then we can all talk about it and dissect it a little bit more in a looser format like this one, if you're available.
Sure, anytime.
I look forward to it. Brett, thank you once again very much for joining us. It was great having you here. I hope everybody watching enjoyed his insights as much as I did. And I would like to thank all of you for watching. So like, subscribe, send your questions, put them in the comments, and hopefully we'll answer them in a future video. Thanks for watching.